higher yields in Europe once again this morning then, Mark. I see German Bund yields are up 2.9% right now is where they are. That is the yield. It's not all that far from 3. Any sign that this stops anytime soon?
At the moment, absolutely not. As my colleague Dave Goodman just put in our internal IB chat, the way it works at the moment is you walk in, digest some incredible overnight news, watch markets do historic things, and then rinse and repeat. It really is kind of unprecedented times in markets across asset classes. At the moment, the last kind of 36 hours, it's bund yields really stealing the limelight, and these are major moves at the moment. I am slightly worried that markets are overestimating how quickly the ECB will incorporate these new spending plans into their projections. Certainly, we've priced out one full rate cut pretty much since the end of last week, so it's very, very rapid. And I think that these plans from Germany really are massive. I think this is really consequential news, and that's why I said yesterday I expected much more topside in euro dollar. I didn't expect it to happen quite so quickly, but I said that overall it's a theme to happen that's going to continue throughout this year or maybe longer term. This is a paradigm shift for Europe and for Germany. In the very short term, now we've got ECB going ahead. There's surely got to be in the next few hours some people tempted to take some profits on the incredible moves of the last couple of days.
Yeah, we have images of Christine Lagarde scrabbling to rewrite her speech ahead of the press conference. To your point, the ECB market's fading out their bets, now fully pricing in just 2 cuts. 108 on euro dollar, Mark. Talk to us about your comfort level for moves higher in euro. Where does that take you?
So, as you know, Tom, since December, I have, been bearish the dollar in terms that I think that the analysis around tariffs was quite misplaced. There was very much based on a theoretical analysis. They work in isolation, no reciprocal tariffs. I think that this year is going to be bad for a dollar that is very overvalued, and the world is structurally overexposed to US assets. So I think it's the end of US exceptionalism in terms of markets, and that's very negative for the dollar because overpriced equities have been a large part of that flow. So I think the dollar weakens, and I think this news on Germany is structural for euro. I think people are going to be seeking to, at the margin, I'm not talking about the end of dollar as the world's reserve currency, but at the margin, they're going to seek to lower their exposure to the dollar, and as part of that, euro will gain. So I think over the coming years, I think euro dollar goes much higher. I think we're going to start talking about levels like 120 again, 125, 130. I think that's what ahead of us the next few years. Short term, I have no particular view. Short term, I think it's gone quite fast, quite quickly, and I'm a little bit nervous. But the longer term picture, this is a lot higher to go over the next couple of years.
It was interesting just listening to Ben Smith talking about the structural demand coming out of the United States, US tourists coming to Europe. You wonder at 1:30 how significantly that changes. Just very briefly, in 20 seconds, Mark, can European equities survive a downdraft in US equities? What's the beta right now?
I think they'll get hurt a little bit, but you've got to remember these aren't as expensive markets. I think the general theme at the moment is in this world of greater uncertainty, greater volatility, greater risk premium across assets, you go to value. And there are many stock markets around the world that are heavily discounted. Europe's no longer that case, but it's not as over expensive. So it gets hurt, but not so badly.